will be examined a bit later. But before we get there, let's see if we can learn a few tricks of the trade. We'll begin by tackling the toughest problem of all. How in the world do we go about estimating the next 30-plus years of earnings, and on top of that, try to figure out what those earnings are worth today? The answer is actually simple. We don't. Instead, we just make the challenge easier. We start with the assumption that there are other alternatives for our money. In my book, the main competition that any investment has to beat is how much we could earn risk-free by loaning money to the U.S. government. For our example, and for some reasons I'll discuss later, we'll assume that we could buy a 10-year U.S. Treasury bond that will pay us 6% a year for 10 years. This is essentially lending the U.S. government money for those 10 years with a guarantee that they will pay us 6% each year, and then pay us all of our money back at the end of that time. Now we finally have a simple standard that we can use to compare all of our other investment choices. If we don't expect an investment will beat the 6% per year that is available risk-free from the U.S. government, then we won't invest. That's a great start. Let's see what happens when we use our new tool to evaluate an investment in Candy's Candies. If you remember Candy's Candies from Chapter 2, it's really just our neighborhood candy shop. The business is for sale at a price of $100,000. Our best guess is that the business will earn $10,000 after taxes next year, and that earnings will continue to grow a little bit each year as the town continues to expand. In practice, I assume that next year will be a normal year for the business. A normal year is one where the economic and business conditions are typical, not extraordinarily good or bad. So here's the question. If we invest $100,000 to buy the entire Candy's Candies business, and we earn $10,000 on our investment next year, is that better than taking that same $100,000 and investing in a U.S. government bond paying a guaranteed 6% per year for the next 10 years? Let's see. The most obvious thing we can say right off the bat is that earning $10,000 in the first year on an investment of $100,000 is equal to a 10% return on our money. 10,000 divided by 100,000 equals 10%. This is usually referred to as an earnings yield of 10%. That's certainly higher than the 6% risk-free return we can get by lending money to the U.S. government. But unfortunately, that's not the end of the analysis. The 6% from the government is guaranteed, while the 10% from Candy's Candies is just our best guess. Also, the 6% is guaranteed for 10 years. The 10% return is our best guess for only next year's earnings. On the other hand, in future years we expect that 10% return to grow as earnings increase each year. In short, we are comparing a guaranteed 6% annual return that doesn't grow or shrink to an expected, but risky, 10% return that we think will grow each year. But since it's a guess, it could also shrink or disappear completely. How do we compare the two investments? Here's where it gets interesting. Are we very confident of our earnings estimate for Candy's Candies? Are we very confident that earnings will grow over time? Of course, if we are, a 10% return that grows even larger as each year goes by could well be very attractive when compared to a flat 6% return. If we're not very confident about our estimates, we might determine that the sure 6% from the government is a better deal. But that's not all we can do with this analysis. Now we also have a way to compare an investment in Candy's Candies with some of our other investment opportunities. Let's say we also have a chance to buy our local Bad Bob's barbecue restaurant. Bad Bob's is also available for $100,000. Bad Bob and batteries not included. We expect Bad Bob's will earn $12,000 next year. That's a 12% earnings yield for the first year. We also expect that earnings will grow even faster than Candy's Candies over time. In addition, we are more confident in our estimates for earnings and future growth prospects for Bad Bob's than we are for Candy's Candies. So while we still don't know if either investment is more attractive than a government bond, we at least know that we think Bad Bob's is a more attractive investment than Candy's Candies. Why? This one's easy. We expect to earn a 12% first-year return on our investment in Bad Bob's versus 10% for Candy's Candies. We expect that 12% return to grow faster than Candy's Candies. And we have more confidence in our estimates for the local barbecue place than we do for the candy store. So first, we compare a potential investment against what we could earn risk-free with our money. For purposes of our discussion and for reasons that will be detailed later, we have set the minimum risk-free rate that we will have to beat at a 6% annual return. If we have high confidence in our estimates and our investment appears to offer a significantly higher annual return over the long term than the risk-free rate, we've passed the first hurdle. Next, we compare our potential investment with our other investment alternatives. In our example, Bad Bob's offers a higher expected annual return and a higher growth rate, and we are even more confident in our estimates than we are for Candy's Candies. So we obviously prefer Bad Bob's over Candy's Candies. Of course, if we have high confidence that both investment alternatives offer a better deal than the risk-free government bond, we can always decide to buy both. But in general, this is the basic process that I go through when evaluating and comparing businesses to invest in for my own portfolio. When I teach this concept to my MBA students, at this point in the discussion, I always ask them the following questions. What happens if we are trying to value a company and we're having a hard time estimating future earnings and growth rates? What if the industry is very competitive and we're just not sure if current earnings are sustainable? Maybe we have a question about whether some of their new products will be successful. Sometimes we're not sure how new technologies will affect a company's main service or product. What are we supposed to do then? My answer is always simple. Skip that company and find one that's easier to evaluate. If you don't have a good idea about what's going to happen in the industry, with the company's new products or services, or the effects of new technology on the company, then you can't really make good estimates for future earnings or growth rates. If you can't do that, you have no business investing in that company in the first place. But I know what you're thinking. Thanks for the advice, but this stuff still sounds really hard to do.